Today is the 1st April 2024, the start of this financial year, a new financial year to bring us more prosperity and a lucrative market journey. The last 1 year has been a roller coaster ride for investors in the Indian stock markets. The recent wave of corrections has left even the seasoned experienced investors feeling unsettled. After the staggering rally over the past 1 year, this correction is not a surprise for many. However, when it happens, it hits the portfolios hard. To put the past high year returns in context, since 2005, only 15% of the time have the broader indices generated such high returns within a 1 year period. Let's look at what the three main indices composing the stock market have done in the last financial year. The small cap 250 index has risen a record 80% from April 2023 to Feb 2024, which was its peak, and then corrected by 14% during Feb and March to still record a gain of around 67%. Compared to its long-term annual average return of 14%, this is 4.5 times the returns. Similarly, the mid-cap 150 index has risen from a level of 11,337 on the 1st of April 2023 to a 62% gain by the 8th of February, which was its peak, and then corrected but still ended at 57% gains for the entire financial year. The Nifty 50 benchmark index of the top 50 companies has clocked 32% gains for the year without much volatility in Feb and March. These staggering returns have also prompted the regulator SEBI for cautioning the retail investors about a potential bubble in the small cap stocks, especially on the lower capitalization like the SME and the micro cap space. SEBI has also instructed the mutual funds to limit their inflows into the small and mid cap schemes and mandated stress tests to assess the liquidity of these funds. A stress test of liquidity is typically where there is a simulation that if all the investors want to liquidate their holdings from a mutual fund, how much time does the mutual fund take to liquidate all its shareholdings and pay back the money to the investors? These slew of measures and communication from the chief regulator of the market have further aggravated the uncertainty at a volatile time and added to the swings in the market for the key market participants. Now, we suggest our investors and our community to consider several points to calibrate their approach going forward, because no 2 years are similar in the stock market, as we know from experience. There has been a big surge in the PE ratio, that is the price earnings. Price earnings is an indicator where we compare the price to the earnings and see the relative valuations of the market or the index or the stock. You will be surprised to know that the PE ratio for the small cap index has surged by 63% from a low of 18.04 at the start of the year to 29.5 by the end of February. Usually the PE level of 30 is considered as the peak for the small cap index based on the past trends. Similar big rise in PE is also observed in the mid cap 150 index. The above mentioned surge of 70% gains in a year and 60% PE ratio increase for the small cap index has led to creation of bubble in some parts of the wider small cap stocks universe. This is mainly caused due to the inflated stock prices without corresponding increase in their intrinsic value in a short period of time, excessive optimism and liquidity coming into the markets, and a herd mentality which sets in amongst the investors to check and chase stocks with a strong upward momentum. Looking at the levels of the corrections experienced in this space, it can be said that these appear to be very normal, regular time and value corrections in the markets during a bull run. Also, it is important to note that Nifty 50 didn't even join in this type of a correction in March 2024, which means we don't have any signal yet that the rally is over or it is taking a pause. There would be many sectors and companies and the mid and small space as well, which can look good from a future valuations perspective once the next set of annual results are declared in May 2004. Thus, it is correct time to relocate at your portfolio allocation. As compared to the mid and small cap stocks, the large cap stocks have largely underperformed, and this is because the 32% gains in the Nifty 50 have also been driven by only a few set of stocks compared to the mid and small cap space where there has been a ferocious and a broad based bull run. To conclude, based on the past market patterns, there is likely to be a potential reversion to the mean, wherein the large caps are likely to start outperforming the broader indices, which will underperform, and there will be a parity of returns. Hence, if you have a disproportionately high allocation to small caps, especially micro caps, it can be time to rebalance the portfolio with allocation into the all three caps. But a spread across all caps is always recommended, and not to shun the small cap space, because Mr. Market is supreme and those trying to time the market based on predictions and estimates have always got a lesson in humility in every cycle. Wishing all again a very lucrative financial year 2024, and to remember the calibration of approach as suggested in this video.